In today's Targets in Focus, we'll be taking a look at dollar CAD, dollar yen and euro dollar. I'm joined on the line by Craig Ferguson, Director of Strategy at Antipodean Capital Management. Hello, Craig. The US dollar rose after weak data from the United States, Europe and China stoked global growth worries. Based on this, what are your short, mid and long-term projections for the dollar against the CAD?
Our forecasts tend to favour a stronger CAD over the next 3 to 6 months, heading down towards the low 90s. That view is based on a number of different drivers. The first is that commodity prices we expect to rebound. CAD being a commodity-sensitive currency should benefit in that. If that's the case, our view is that we are right at a base in global growth. In the global growth cycle, and we expect the global growth cycle to pick up again. In the US, we also expect a strengthening in economic data into Q1 of 2013, and as a result, we normally get a strengthening Canadian data with a 1 to 2 month lag as a result. So our bias is for 3 to 6 months of Canadian dollar strengthening down towards the low 90s.
The Japanese yen underperformed as much as 0.5% down against leading currencies as rating agency Moody's warned the potential cancellation of bond auctions because of political gridlock over a debt financing bill is credit negative. What are your forecasts for the dollar yen?
Our view is that the dollar yen continues to move higher over the course of the next 3 to 6 months. We're actually getting towards our forecast height, which is around the 81 level to the yen, and it may be possible that we actually see some extension through that level towards 83 or 84, which we don't currently have in our forecast, but which we may build in to those forecasts. That view is based again around a strengthening in US data, but at the same time a continued issues in the Japanese economy and in the Japanese debt market, as you mentioned, which should weaken the yen.
The euro dropped the most in 2 months against the dollar as services and manufacturing in the region shrank to a 3-year low, adding to evidence that central bank will need to do more to spur growth. What are your projections for the euro dollar?
Normally, when we get a period of stronger US economic growth, as we expect for the next 6 months, somewhat perversely, we tend to get US equity markets outperforming. That's actually expected, but the dollar actually weakens under that scenario. It's usually seen as a funding currency. So our view on the US economy would be one that that actually plays out via a weaker US dollar. In terms of EU drivers, we do tend to think that the EU economy is finding a short-term base. We've certainly seen a base in the EU PMI surveys. Services sector hasn't based yet, but we normally get a lag of 2 to 3 quarters or 2 to 3 months there to manufacturing data. So we do tend to think that EU economic data is starting to rebound. Financial conditions are very, very easy. They're the sort of conditions that would suggest that we get a strong rebound. And we do think that the OMT plan that was announced by the ECB a number of months ago is actually a little bit of a game changer in the short term, over the next 1 to 2 years. And it does take away, as long as it's actually activated, that is, the prospect for sovereign default and exits from the Eurozone outside of Greece, that is. So our view is for a move up towards 135 in the very short term, and then into the 140 to 145 area 6 to 9 months out for euro.
And which currency pair do you think is most at risk and which is least?
I guess our view is that the commodity currencies will continue to outperform, in particular the New Zealand dollar relative to the Australian dollar and the Canadian dollar. The New Zealand dollar does look like it's got the soundest fundamentals, certainly not easing in policy there just at the moment. And the earthquake rebuild has been very, very strong and will continue to be a very strong force for good in the New Zealand economy going forward. So we expect the New Zealand dollar to get up into the 90s over the next 12 months. In terms of the weakest currency, most likely that will be the dollar. Our view is that we get the dollar down in terms of the index down to between 71 and 74 over the next 12 months.
Thanks for joining me, Craig. Well, that's all we've got time for right now, but stay tuned to Dukascopy TV for more updates and interviews. For now, though, goodbye.